welcome to the show.
Welcome to 2025. Oh, and I
You
messed that up.
You have the wrong date on there.
I have the wrong date on there.
So when you see this, you didn't go back in time. It
Nope.
is January 25.
Funny, though, Santa Claus Rally ended much like it did in going into 24.
Did it really?
Yeah.
I was waiting for you to tell me how it went.
Yeah. Well, we're going to talk about that. But, yeah, sorry about that. Date is obviously January 5th, 2025. A lot of stuff to talk about this week. So we're going to do what happened this week, Santa Claus Rally results. It's Friday, so today is actually the last day of the Santa Claus Rally. It's about 10:30 in the morning on Friday. Market's up about 0.5%, so it's not going to really affect the failure of the Santa Claus Rally. And we'll take a look at CNN Fear and Greed Index, because ordinarily the Fear and Greed Index is a contrarian index. So when you are at extreme fear, it tends to be a bottom. When you're at extreme greed, it tends to be a top. But it's not always that way, and it's what's been happening over the last couple of months is kind of interesting. And then the monthly candlestick charts gives us the long-term trend, and then we'll look at the regular weekly TSP charts. Before we get to all that, a little PSA, public service announcement.
Administrative announcement.
If you haven't seen this, the market is closed, and the federal government is also closed on January 9th in observance of Jimmy Carter's passing. So, like it says here, transactions that would have been processed Thursday night will be processed Friday night. When I read it, I took it in a completely different way at first. As Conan pointed out, it says right there in the first sentence, some financial markets and the federal government will be closed. So I just looked it up. Yes, the financial markets are closed.
Jerry was just mad he wasn't getting a day off. He thought the market was open and the government was closed, and he's like, damn it.
Yeah, right. So actually, now that you say that, that's a good thing. We do get a day off because the market's closed.
The market's closed. That's the only days we get off.
That's awesome, now that I think about it. So anyway, it won't affect anything. Since the market is closed, it doesn't really matter. When I first looked at it, I was like, the TSP is taking the day off because the government is closed, but the market, I thought, was still open. And what I was going to point out was that transactions that would have been processed Thursday night, right, January 9th, will be processed Friday night, which would mean, if you put in a request on Thursday at noon, and this is still the case, if you put in a request at Thursday at noon, it's going to take effect Friday's closing price.
Yeah, no matter what, that part's still the same.
Right.
Because the point is, the really takeaway is the TSP is not working on the 9th. So if you do anything on the 8th or 9th, it's not going to be the same. Meaning, afternoon on Thursday.
On the 9th.
Yeah. Anyway, point is, it's going to be Friday's closing.
Right.
So that's going to happen no matter what. And that's just, the good thing about it is the market isn't open. If it was open and things were changing, that would suck.
That was how I read it at first.
This isn't a huge impact because it's going to do what it does on Thursday. You can get it in by noon, and then it does what it is on Friday, and you get it in before noon. You're okay.
Yep.
Hopefully all that made sense.
It's just like a weekend.
Yeah.
It's just like a one-day weekend. Okay.
Well, then why couldn't they do it on Friday so we could have a 3-day?
Right?
Come on, Jimmy.
I don't think he had much input.
He had zero input.
But yeah, the 10th would have been, or the Monday, yeah, but well, whatever. Okay, so what happened this week? We got pending home sales. Pending home sales month over month, right? So we're talking about, I guess, December versus November. I don't think we haven't gotten January numbers yet. So December versus November. Pending home sales are up 2.2% versus an expected 0.9%, which is quite a bit, right? More than double the pending home sales that they expected. S&P was down 1.14%, but so this is the drilled in on the pending home sales. Pending home sales in the U.S. rose 2.2% month over month in November, above the forecast 0.7 increase and following a downward revised 1.8% in October. The big takeaway here is that this is what they think happened, right? Consumers appeared to have recalibrated expectations regarding mortgage rates and are taking advantage of more available inventory. Buyers are no longer waiting for an expected mortgage rates to fall substantially. So that's really the thing. Buyers are no longer waiting for interest rates, mortgage rates to fall. And we've been talking about that since the Fed started its rate cutting cycle. The bond market has not played along, right? Rates have continued higher, even though the Fed is trying to push rates down. And now they're at the point, apparently, that buyers are no longer waiting or expecting mortgage rates to fall substantially. So the next, which is kind of interesting, on Tuesday, the Case-Shiller home price month over month comes in. And so prices month over month are down 0.2% versus down 0.3% last month. So yeah, they're 0.2% less than they were last month. And last month also was coming down. So median home prices are coming down a little bit, right? But there are a lot of analysts that are expecting 2025 to be really, really tough for the residential real estate market. And we're certainly not seeing a collapse, right? 0.2 and 0.3 over 2 months isn't a big decline in home price. So home prices are staying high, and buyers apparently are not expecting interest rates to come down. So who these buyers are that are buying at this price level, I just have no idea. I mean, it's the most unaffordable, the highest level of unaffordability, I think, in history right now. So if you're out there trying to buy a house, it's very, very rough. S&P's down 0.33% on Tuesday. Wednesday, markets closed for New Year's. Thursday, as we kind of would expect, the 30-year mortgage rate is up. It's just below 7%. It's probably at 7% now, but as of last week, 6.97%, up from 6.75%. It's a pretty big jump. Rates they're certainly not trending down. They're trending up. Last week, applications fell 12% versus 0.7% the week before. So on the last slide, we were talking about pending home sales are going up. And on Thursday, a different report comes out and says new mortgage applications are dropping like a rock. So, residential real estate is all dependent on where you live anyway. So, it's very tricky out there. Initial jobless claims were 211,000 versus 219,000 last week. So that's pretty good, right? Certainly not an increase in new jobless claims. And S&P is down 0.2%. And then on Friday at 11, the manufacturing PMI is going to get released. A reading below 50 means that the economy is contracting. A reading above 50 is the economy is expanding. And it's been below 50 every month since March of 2024. So it'll be kind of interesting. If we can get back above 50, that's a really good sign for the economy, but it hasn't been above 50 in quite a while. And then the S&P was up about 0.5% at 10:30 this morning. Okay. So finishing up on the Santa Claus Rally, right? This is a pretty interesting one from MarketWatch. So stocks are skipping the Santa Claus Rally again this year. That doesn't bode well for January, which is statistically true. Statistically, when we don't get a Santa Claus Rally, the first week of January tends to be down. The whole month of January tends to be down. And when all three of those are in place, the year tends to be down. So we talked about this actually the last 2 weeks in a row. Santa Claus Rally, we don't have to go over the whole thing. Gets kind of coined by Yale Hirsch in 1972. It's the last 5 trading days of the year and the first 2 trading days of the following year, which today, Friday, January 3rd, is the last day of the Santa Claus Rally time period. So these 7 days have historically shown higher stock prices just about 80% of the time. Okay, so if you were in Vegas betting on it, you would bet 80% is pretty good, right? Reflected in the S&P 500. Okay, Stock Traders Almanac compiles the data during the 73 years from 1950 to 2022 and showed that the Santa Claus Rally occurred 58 times, roughly 80%. And the growth in the S&P on average is 1.4%. So the big thing that people look at is this triumvirate, right? You get the Santa Claus Rally going into the beginning of the year. The idea is if the Santa Claus Rally is strong, the first week of January tends to be strong. If the first week of January is strong, the month tends to be good. And if the month of January is good, then the year is generally positive. Obviously, that doesn't always happen. And what's interesting is that this is the second year in a row that we did not get a Santa Claus rally. So from a short-term perspective, this is the 23rd is this day right here. That's the beginning of the Santa Claus rally. Okay, so we showed this chart last week. This would have been where it began. So as of last week, we were up at 1.07%. So the Santa Claus rally was off to a good start. Okay, we had talked about it needs to get above the prior high, but this has nothing to do. The Santa Claus rally is just this time frame right here, right? It's just those 7 trading days. So what actually happened was this. And again, this is as of Thursday's closing price, so it doesn't take into account Friday. But we were here, and then the market rolled over, and here we are. So as of Friday at about noonish, we're right about here. So obviously, maybe we won't have a 1.7% drop for the week, but we definitely are not going to have a positive Santa Claus rally. Does it really matter, right? This is a chart. Okay, here we are in May 2023, and here's where we are right now. So here's 2024. This section right here was a failed Santa Claus rally last year. Okay, what happened? We had a little pullback down to that 20-day moving average line in blue. We had a little pullback, got support there, and kept on going. Okay, I tend to. Everybody talks about statistics, and I really don't like it. I think the trend and pattern of the market is what happens. You can't take. It's like baseball. I guess there are a lot of people that look at the numbers in baseball and like, oh, this guy has a 300 hitter or all the stats in baseball. It's insane, right? But every time you go to the plate,
it's a new bat.
It's a new bat, yeah. Right? So,
yeah, I kind of struggle with this all the time because I'm a big data nerd. I believe that data tells us things, right? Yeah. The secret sauce really is the analyst, not the data.
Yeah.
So if you just take data from a flat perspective, right, which is generally what statistics is doing, it's not analyzing it for you.
Right.
It's just telling you this has happened 27 times out of 30.
Right.
That is the truth. Those are facts, right? There's no bias. Right. Well, hopefully there's no bias in the way they figured it out. But anyway, then, until we get better AI skills, a human has to analyze it and think, what does that mean? What is the importance? What is the weight of the importance?
You're going to give that, yeah.
Right. Santa Claus Rally, I think, is something like that. It's something that over time has generally predicted X, right?
Yeah, statistically.
Statistically. But you can't, it's not strong enough based on what you just showed, right? And you could go back and see it a few times. It's not strong enough to hang your hat on and say, oh, this is what's going to happen the whole year. And that's what a lot of people do is they hear something like this and now they're biased. Right. Now, I will be biased until told otherwise, right. Meaning the market responds differently. So go back to that chart, or you're on it. Yeah. Sorry, I'm on us. Go back to that chart and circle where the Santa Claus rally is.
That was the Santa Claus rally failure.
Yeah, and look at all those other downturns as we go through that time frame, right? It's much larger.
Right. You keep getting support at that 20-day moving average line. There's a couple of different things here, right? We had a pretty big correction in the summer. It went from August through the beginning of November, which is a pretty long correction in 2023. And so once we had this gap up breakout, every time it came down, it got support at that 20-day moving average line, right? All the way through until this first correction in early 2024.
Yeah, that's what I was. So I'm talking about in 24, all through there. So where I was going with this was don't put so much weight on one historical piece of statistics or however you want to phrase it. Just use it as a as a heads up. So think to yourself, all right, I'm going to be a little more biased for a while. So where I'm going with this is that's the difference between predicting and responding.
Right.
If you use something like this, statistical analysis, historical data, what have you, seasonality, any of these things, what some guy said on TV, what some person said on a podcast.
Sure, yeah.
If you use that to predict what's going to happen, you're probably going to fail. If it puts you in a position to be ready, which you should be anyway, to respond, that's where you're going to win.
Yep.
If you're using it to predict the market, you're probably going to fail. If you're using it to help you respond, you're on track.
Right. It's helpful. It's
it's not.
If
not
statistically, right. If so you're going into 2024, let's say, and the Santa Claus Rally failed. And statistically, when the Santa Claus Rally fails, you have problems in first week of January, then you have problems for the month, and you have problems for the year. 24 obviously was over 25 probably % gain in the S&P for the year. So obviously the Santa Claus Rally failed, and the expectation based on that failure failed. Right? So at some point, you have to have other inputs. Because if you stick with the narrative, you'd be wrong the whole year.
Well, just respond to it.
Right, which kind of gets us to where we are now. Okay, so we found, so this was the Santa Claus Rally in going into 24. Price came down, found support at that 20-day moving average line, and kept on going. Right, there was no break in the trend at the time. Right, it just kept on going. That's not where we are right now. The yellow orange line, whatever, right here is the 50-day moving average line. Okay. On that first move down on the 19th of December, that big candle right there, that was just under a 3% move to the downside in the S&P. I don't remember if I did it on a podcast or the newsletter. I think it was I can't remember which. It was the podcast or the newsletter that week. You don't get 3% down moves during a bull market. And that was a shot across the bow. That 3% move down was a shot across the bow. So it closed obviously below the 20-week and below the 50-day moving average line. Then we had a little recovery, and it did not get above the prior high, right? So now we have a lower high. We got this peak here. Should have blown this up, but basically you have this level that is a huge support level for the S&P. And it looks like a head and shoulders pattern, right? You got a left shoulder, a head, and a right shoulder. And this is the neckline. If it breaks below that neckline and we get down here somewhere, the implication is the price goes down. Okay? And as long as price is below that 50-day moving average line, as this orange line starts to roll over and turn down, price comes up and keeps hitting it, can't get above it, it's resistance there. And when these lines start rolling over, it's harder for price to get back above them. So the fact that we're below the 50-day and we've been there for a few days, that's more of a problem from my analytical perspective than the fact that the Santa Claus Rally failed. Does that make sense? And so this line is really, really important. Is it possible that we bounce and keep on going? Yes, it's possible. If you're in the G fund right now and you are very risk tolerant, this is a great time to get in, because if we break below that line, you just get out and you took a little bit of a loss. But if the market does find support at that line and starts moving higher, you would get all the gains.
Just understand, you would be predicting and gambling. There's no guarantee. So,
no guarantee either way.
Yeah.
Right.
What we normally do is respond once we see that it's changed. Right. But you can do what Jerry said, and that's just where the risk factor comes in.
Right. Now, if you're in a brokerage account or an IRA or something like that,
much easier.
It is a no-brainer positive trade, because your risk is so low, right, relative to your expected upside. If the rally keeps going, if the rally is going to sustain.
But just to make sure they don't miss that, the risk is low because you can move in and out at will.
Right.
That risk is increased in the TSP because you can't do that.
Right. I mean, you can. So it's January. So you have 2 new moves. So if you
would have just blown your moves.
You'd have blown your moves.
But I'm saying that the risk is higher because of all those issues.
Right. So in this case, the risk is, so it's January 3rd. So if you're in the G fund and you do your first move into, say you go all back into the C fund today, because it closes above that line today. If the market keeps going higher, you're gonna win for sure. That's the best scenario. If it closes below that line, say you lose 1%. The losing the 1% isn't the problem. The problem is now you're using your second move to get back to the G. Now you can't do anything until February, right? So that's the kicker, and there's nothing we can do about that. So we talk about IRAs and brokerage accounts and all that because there's a lot of people that are in the group and listen to the podcast that are using this information for different kinds
things.
Of purposes.
And it's important for us to point it out so they understand that when you're listening to financial market information, you have to put it in the right context. Yeah. Are you talking about a tax, non-taxable account, right?
Yeah. Retirement account.
Retirement account that doesn't have tax implications. Or are we talking about a brokerage account? Are we talking about the TSP? Because the rules are different. Everything's different. So you need to know. You need to put it in context when you hear information, advice, whatever it is. Yep. That's the real big takeaway. Here we're primarily talking about the TSP, and I do have people ask us every once in a while, if you guys are talking about the TSP, why do you talk about brokerage accounts? Why do you talk about? Well, because we have the mutual fund window, and you can kind of use that like a brokerage window, an IRA, whatever. It's got similar rules, so it is important to understand this stuff, but. More than anything is to make sure people understand that not everything is in the same context.
Right.
So very different implications. One is the restrictions that are placed on your 401k, IRA, whatever your retirement account is. Because if you just say retirement account, that's not good enough. Because in a 401k, I'll give you an example. A friend of mine has an ADP. We have ADP 401k, and depending on how the company set up their rules. Your change, here's what's crazy, your change doesn't even take effect until your payday because that's when they do the change. Yeah. It's not when you made the change in your account. Yeah. It registers at your next payday, which could be 2 weeks from then. Yeah. Like, how crazy is that? So the point is you can't actively manage that type of 401k. Yeah. Your best hope is just to buy and hold. Yeah. That's all you can do. But not to get sidelined, it's just important to realize, okay, what context am I in? What am I talking about? And so it's very important because we hear all the time, particularly in our Facebook group with 30,000 people, spouting advice that is clearly in the context of a brokerage account. I mean, that's the way they're thinking. And you're like, you can't do that in a TSP account, Yeah. Anyway. Yeah. I'm off the rant.
Yeah. Yeah, I mean, I had somebody ask the other day, why do you talk about? I can't even remember what it was. Why do you talk about this stuff now?
Bitcoin or something? Yeah.
Yeah, I'm like, it's all
we're an education service.
Yeah, well, yeah.
At the end of the day, that's what we're trying to do is educate you.
Yeah, and everybody has a different circumstances and risk tolerance. I mean, you take the information and you we're giving you a lot of analysis and perspective on it, and you have to make your own decision. All right. CNN Fear and Greed Index. So this is pretty interesting because it's definitely ordinarily a contrarian index, meaning when fear is high, it tends to be a bottom in the market. When fear is really low, when greed is really high, what am I doing? Fear and Green Index. Anyway, here's what it was on January 2nd. So this is Thursday, about 2:30, and I looked at it this morning on Friday, and it was still at 26. So, you're at just about at extreme fear. Okay, we're just barely in the fear, almost at extreme fear. And the previous close, we were at 27, so we're a little bit more fearful than we were on Wednesday. A week ago, we were in the fear, but it was 33, so it's the fear meter is getting worse. A month ago, we were at greed, okay? And then a year ago, we were at extreme greed. So this is the default view of the CNN Fear and Greed Index, and actually, I like this view better. It's over time, and you can toggle it on the site. And so this is just the same numbers, just over time. So if you could have overlaid a chart of the S&P 500 on top of this Fear and Greed Index, we weren't quite at extreme fear, right? But we were pretty close to it at that April low last year, right? We had that correction, and by the time we got to the bottom of that correction, the lowest day on the Fear and Greed Index was the low of that correction, okay? Then the same thing in the summer. We had this summer correction. The lowest day in the Fear and Greed Index was the low of the summer correction, which is why they keep saying it's a contrarian index. When we get way down here in the extreme greed areas, we're likely at a bottom, okay? And that's kind of where we are right now, right? We're right on the verge of that extreme fear. So if you look at it from the way it typically is, the market should be getting ready to rally from here, right? Because when it comes out of those bottoms, it rallies quite a bit. The problem, or what's different this time, is that the Fear and Greed Index has been falling, even though the S&P 500 had been rising, right? Because it peaked on December. I think it was this one. This was the December 18th, 17th, 16th, something like that was the peak, and it's been basically rolling over since then. And we had a high in October on the S&P, but we had a higher high in December, but we have lower highs on the Fear and Greed Index, right? Which is kind of strange, right? It's meaning that fear is increasing, even though the market is continuing higher. That's not what's supposed to happen. And so it puts us in a position to say, okay, we are at, sentiment-wise, at very close to extreme fear. Does that mean the market is ready to rally? Or does it mean that it keeps going down? I mean, historically, it would mean the market's getting ready to rally. A piece of that is price strength, right? A piece of the Fear and Greed Index. This is net new 52-week highs and lows on the New York Stock Exchange. So 0 means there's an equal number of stocks making new highs and stocks making new lows, which on the face of it is kind of strange anyway, right? How do you have half the stock market making new highs and the other half making new lows? It's odd. But now you clearly have more stocks making new lows, and when you have that, it tends to be a bottom, right? So that's why this particular section is extreme fear, because there are more new lows than there are new highs, and that doesn't last for long. So the question is, do we get a big snapback right now, or is there reason to be extremely fear and the market, tanks? So that's kind of let me see if I have this. Yeah. So a few big stocks can skew returns for the market, right? We know that. It's important to also know how many stocks are doing well versus those that are struggling. This shows the number of stocks on the New York Stock Exchange at 52-week highs compared to those at 52-week lows. When there are many more highs than lows, it's a bullish sign and signals greed, right? And again, they're talking about this chart. So we have way more new lows than new highs at this point. And when they say a few big stocks can skew the returns for the market, we all know it's the Magnificent Seven that do that, right? So this is a chart of an ETF that's called MAGS, is the ticker symbol. It's the Magnificent Seven ETF, okay? So Magnificent Seven peaked back here in the middle of December, right? And it's pulled back since. This is the 50-day moving average line. We know the Magnificent Seven is what's driving the S&P 500. It's above its 50-day moving average line. If the Magnificent Seven comes down here, tags that 50-day moving average line, and explodes to the upside, the S&P is going to go ripping to the upside. If the Magnificent Seven continues down, and breaks down through that 50-day moving average line, the S&P is going with it. So what you really want to watch right now is what happens with the Magnificent Seven. I didn't look at it today yet, but Apple has been way down. It was down like 3% yesterday. I mean, those Apple, Google, Amazon, whatever, Facebook, and Tesla, 7 of them, whatever.
Yeah, I lose track too.
Yeah, I mean,
there's 7 of them.
If this thing pulls back, finds support there, and explodes to the upside, the rally keeps going and everything's great. If the Magnificent Seven roll over, the rest of the market has already rolled over.
Yeah, they're not pulling it up.
That's what this is. This is the rest of the market. It's already rolled over.
Yeah, if Mags rolls over, there's nothing to pull it up.
No,
it does work the other way around.
Well, if it finds support there and keeps going, the rest of the market is so oversold. There's a lot of pent up energy there that the thing can explode to the upside, right? That's the thing. Like we are on, it's gonna go one way or the other within the next week. Like it's gonna blow one way or the other. And if you want to guess which way that is, have at it. If you want to respond to what happens, that would be my recommendation. Okay, and in the big scheme of things, here's the C fund, right? This is a monthly chart. So we just finished December, so now we're in a new month. I went all the way back to 1985, not for any particular reason other than obviously the overall trend is up. This is a logarithmic scale, so it's a little bit. You just have to understand that you're looking at a logarithmic scale and not a nominal scale. But this was a 50% decline. If you were 100% C fund up here, your account was worth 50% less down here. If you were at 100% C fund here, you were 55% less down here. So, but if you rode the whole thing from 1985, obviously, you're in an uptrend, which is great. One of the things that we're going to be coming out with in these new models that we're doing is a long-term kind of view like this. If you look at this, this is the 50-month moving average line, right? In yellow, and the 20-month moving average line in blue. So when those cross, when the shorter one crosses the longer one to the downside, that's where most of the losses happened after the 2000 drop, and certainly in the 2008 drop, right? If you were just looking at the crossovers of those moving average lines and nothing else, you could have avoided the majority of this on that crossover. And then once it got back above it, it hasn't crossed over again, right? It hasn't come even close. So you could have been, for 2011, 100% C fund.
And that's trading on a monthly basis.
Monthly basis.
Right.
Yep.
Like you would look at it once a month and make a decision.
Yep.
So that's definitely something to keep in perspective. Yep. You can miss those catastrophic losses. You won't miss them all.
Yeah, and this is probably a 30% loss. So I don't know that that's not catastrophic, but yeah.
It probably is, but 50% is more catastrophic.
Worse, yeah. Yeah, I mean, that's the thing. Like everybody talks about, well, what do you mean circumstances and risk tolerance and all that? The broader time range that you look at these things, the more of a percent loss you're going to take before those lines cross.
And you need twice as much to get back to where you were.
Yeah.
That's always the part you don't want to forget.
Yeah. Anyway, in kind of the near term, here's the bottom in 2022, and the market's just rocketing higher. So from a monthly perspective, the trend is certainly up. S fund, I use the Vanguard Extended Market ETF because there's a spike in the DWCPF that messes up the chart, and I don't know why it is, but this is the same ETF that tracks the S fund, and it's a little bit more volatile than the C fund. It began back here in 2002, so we can't go back to like 1985 that we did in the last one. But obviously the trend is up. You get the same kind of crossovers. And again, once in 2010, once the S fund got above the 20 month, got above back above the 50 month, it never crossed down again. So you could have just ridden that out. You had big moves to the upside here versus the C fund. It just depends on what you want to do. But the trend is obviously up. I fund, we talked about this double top, but we're still pretty far below the all-time high from 2007 in the I fund. So at some point, the I fund is gonna explode to the upside. I mean, it's got a lot of pent-up energy over the last 2 decades. So at some point, the rest of the world is going to catch up, but it does not look like it's happening right now. And then the F fund, if you're a 60-40 portfolio person, you're having a rough time. And actually, I think the money managers that have to run a 60-40 portfolio have the worst time because their rules require them to keep their customers' money in the 60-40.
Right, they rebalance all the time to keep that.
Oh, it's brutal.
Yep. And you having to explain that it's impossible.
Yeah.
As to why you would do that now.
Yeah. A lot of people still do it. I mean, it's still. But the scary thing about this for me is 1, 2, 3, 4, 5 for a 1. A, B, C for a 2. 1, 2, 3, 4, 5 for a 3. Like, that's how the Elliott wave pattern goes. The best case is this is A, B, C, D, where the length of that line is the same as the length of that line, and it's a corrective pattern instead of impulsive, and then we get a bottom. Either way, it looks like the F fund is going lower. Certainly, if it breaks that trend line, it's bad. If it gets below this low, it's going lower, which means interest rates are going higher, which means credit cards, car loans, mortgages, blah, blah, blah. And the chart does not look good. And I didn't put the G fund in. No, okay. TSP fund chart. So that was the monthly. This is the weekly. And so don't forget, when we do these funds, these charts, this is the actual TSP data. So if you were to
this
look,
isn't an ETF.
This is not an.
We take the data from the TSP, we put it in a charting software, and that's the actual fund.
The actual numbers, right. So if you went on as of Thursday's closed, if you look at it on the TSP site, it says the C fund is $92.72 a share for the C fund. So if you look at SPX or SPY, it's not going to be exactly the same. And the biggest thing about that is because the dividends are reinvested in the C fund. When you look at the index itself, SPX, dividends are not reinvested. It's just the pure index. And it's the same. You can see it more on the F fund. I'll talk about that when we get there. But the charts look a little bit different than they do on the actual indexes. But this is the actual chart of the actual TSP numbers. So as of Thursday's close, we had a pretty big down week. But again, we're not below that 20-week moving average line. And until we close below that 20-week moving average line, the trend is up. Okay? Relative strength is rolling over. It's not what you want to see to expect the trend to continue higher. But as it is right now, the trend is still up on the C fund on a weekly basis. S fund, same thing, but it definitely needs to hold support there at that 20-week moving average line, which is also the prior high from 2021. So there's a lot going on in the S fund right now. It definitely, we want to see support held there at that 20-week moving average line. I fund is just not looking good, right? It came up, we had a peak, a pullback, got below that 20-week, that's not good. But the fact that we couldn't get back above it and rolled over and made a new low, it's a downtrend, at least in the short term, right? We have a lower high and a lower low. Relative strength is not looking good. So the I fund is definitely not a place to be right now. And the F fund. So this is what I wanted to talk about. So this was the 1, 2, 3, 4, 5 from the monthly chart. But on the monthly chart, so if you did a chart of the AGG, which is the aggregate bond index, right? If you do a chart of the AGG, this price level is below the October level. October 23 is below October 22. It does like this. And it's because dividends are reinvested. So the chart looks different. So if you're looking at this count, you wouldn't say 1, 2, 3, 4, 5, because 5 has to be lower than 3, right? So it's something to keep in mind. We have a lot of people, and I shouldn't say we have a lot of people. I expect that people would like to be able to see charts of the actual TSP numbers, which is why we do this. But in terms of the chart pattern, the indexes are much more important to follow. So anyway, this is the ABC. It's done a 38% retracement from the top, and it certainly looks like it's going lower from here. But we shall see. And the G fund keeps going high right.
All right, guys.
Questions?
If you have any questions, you can send them to us in the comments section wherever you find the video. If there's no comment section, you can always shoot us an email at support@growmytsp.com. The support team will get it over to us. Hope you guys like what you're hearing. If you do, share it with your friends. Tell your buddies.
Yep.
Hope you guys are having a good start to the new year, and we will see you every week.
Every week.
Right here.
Cheers.
All right. Take care, guys.